Garrett,
My name's John Garrett.
Gorin,
I'm Steve Gorin.
Jones,
I'm Susan Jones.
Martin,
I'm Damien Martin, and thank you for listening.
Netram,
I'm Chris Netram.
Pierzchalski,
Jim Pierzchalski. I'm a director here in the state and local tax group at BKD. Came over to BKD in April of 2018. Previously was at a Big Four firm for 12 and a half years, really doing the same type of work, state income tax, but here focus on state income tax, but, touch on different areas, incorporate sales tax, credits and incentives, and I help lead the state tax component of the buy side or sell side tax due diligence reviews. So really touch a lot of different areas at this point.
The question of taxation touches every home in America.
Cutting through the static of the tax world, it's Simply Tax.
Hello and welcome to the fourth episode of a Back to Tax Reform series on Simply Tax. So what do you think so far? I'd like to know, so please send us an email to simplytax@bkd.com with your feedback and questions that you might have from our classes together so far, for a chance to have them read and answered during class. And speaking of, with roll call now done, let's get back to class and catch a conversation I had with BKD's Jim Pierzchalski on applying the TCJA provisions at the state and local level. There's been so much that's changed with the tax law in the last year and a half ever since we've had the Tax Cuts and Jobs Act. And you and I were having a conversation recently, right, about some of those changes and what that's meant at the state level, because I think sometimes it's easy to get focused on all the changes that have been happening on the federal level, but then thinking about how that cycles down and what that means at the state level as well is not always top of mind, and it definitely needs to be right now. So maybe we'll just kind of start there at just what are some of the big takeaways that you have from applying the provisions of the Tax Cuts and Jobs Act in the first year?
I totally agree with your comment, because there's so much emphasis on the federal components to tax reform, obviously, because it is a federal change, but not as much time, or just there's only so many resources, right, at our clients to focus on the state impact and the conformity issues. And so when you're thinking about things like, obviously in 2017, there was the big push on 965, so the repatriation. And now, starting in 18, the focus shifts toward, at least for the bigger issues, I think you're looking at 163J, right? So the interest expense limitation, and then also with GILTI, right? Knowing that there's many other provisions in there, but I think those, have the biggest focus from a state perspective and what bigger clients of ours or companies out there need to be thinking about. And so a couple takeaways I think about, but it shouldn't be a surprise, but there's not a ton of clear guidance across the board. The running joke in the state tax world is that every state interprets things differently, and there's just not uniformity across the board. So that really keeps us busy and causes headaches for taxpayers, right? Because it's not so easy and not to say federal is easy, but you have one set of rules and laws that you're looking at, right? And so with the states, you kind of have to look across the board and really dig into the details to see, what the state interpretation and response is. And then another takeaway that was also kind of a running joke in the state world in the last years. Given the federal tax rate change down to 21%, the mantra we heard for years, especially on the financial reporting side and say tax provisions, state tax, just income tax is just not that material, right? When you're comparing it to the federal component, that 35%, and so now I think that gap has been closed to the effect that state income tax, I think, is much more material for our clients and companies than it used to be. Because you think about states like, say, Illinois or New Jersey, Pennsylvania, that have the higher rates pushing close to 10%. I mean, there's really not that much spread now between the state and the federal when you're looking at all the states across the board. So I think the greater emphasis is out there at this point, and our clients need to be thinking about that. And then the third component, I think, and this is something that we'll get into more, is just the room for interpretation. Given the lack of clarity across the board for state responses, and then you get into the conformity issues, and then you kind of roll down the chains. Like, okay, is this component, is this income or expense component, is it in our base? Is it out of our base? Then you get into the apportionment play from an income facet. So what do we include, if anything? You start getting into the details of, is it in at gross, or is it in at net, or do we get no representation at all, right? Even though we may have something included in the taxable income base. Taxpayers or clients or companies need to be thinking about that now, because you kind of get your ducks in a row. You take a good position, applying the best guidance that's out there, right? Knowing that the state may not agree, but you kind of get things documented why you took the position that you did, and if to say you get audited a couple years down the road, then you're kind of ready to defend that position. So I think that's another big one at this point. There's just so much room for interpretation.
It's almost overwhelming, I feel like, when you start to think about it. Any suggestions or best practices on how to, just again, like a framework almost for approaching that before we start to kind of get into some of the specifics?
I just think, obviously, do the analysis, right? And once you do that, I think documentation is key, because a lot of the additional layers, and if you would get audited, I mean, you're looking a couple of years down the road, right? So you've got the initial federal tax reform that passes at the end of 2017. You're taking positions, or you're looking at 965 in 2018. Now in 2019, you're got your initial run at say 163J and GILTI and other provisions. You file, and then say 2021 comes around, and all of a sudden you're under audit for 2017 through 2019. Do you have the same team in place that actually prepared those returns, that was really in the issues? So you're not starting from square one. And then two, I think consistency is just key as well. States don't appreciate if turning back and forth on positions from year to year. So I think consistency is a key to be able to, prove out, like, hey, this perhaps is just timing, and we've done it consistently over, year over year. Like, even if you don't agree with our position, maybe we can come to some kind of agreement as far as impact going forward.
That's a really great point to make in all this, is being consistent, right? I mean, that definitely puts you in a tough spot. We can maybe talk about some audit considerations or whatever as well as we get through this. But if you don't have that going for you, I think it can present some challenges for sure. So maybe kind of digging in on some of those. You mentioned a lot of things in passing, some of the provisions that have maybe been particularly challenging or ones important to think about. But I know GILTI has been one in particular, right? And again, one that you and I were talking about. So maybe just starting with we talked about the conformity versus non-conformity, but if we have states that are conforming, what are some things to be thinking about with GILTI?
A couple of things, you think about. I mean, I think number one, I think you hit on it. You always kind of got to start with state conformity to the code, right? And I know you've talked about this in prior podcasts, but there's the three different components. There's the rolling conformity, so the state adopts the code absent any legislative change on the state level. I mean, you accept the federal code or adopt it as is, right? And then you've got selective conformity. State picks and chooses which provisions of the federal code it adopts, and then fixed state conformity, like your California, right? You adopt the code as of, say, January of 2015. So absent any legislative fix, you're basically taking a pass on all the federal tax reform, absent any legislative fix. And so with GILTI, I mean, I think first you got to look at, is the income in or out at all? Look for state responses on that, or state guidance on that, and it makes a difference whether or not it's specifically excluded, which then you don't even worry about it on your return. Or two, the state says it's in your base, but then you got to look toward, like, how is the state backing it out? If it is it through a subtraction modification? Are you trying to rely on a state DRD, right? In which case you may not get the full deduction, because there's states out there like Massachusetts that say, okay, we've got a state level DRD, but it's 95%, right, as opposed to 100. So that's out there. And then you got to take the third step, look at the apportionment considerations. If it's in our base at all, should we get some kind of factor representation because we're paying tax on that income, right? And if you do take that position, like how are you calculating that, right? Is it just the component of income that's included in the base for, say, a single sales factor apportionment state? For 3-factor, are you including all of the, CFC, property, payroll, and sales, based on the percentage of income that's included in your base? So there's definitely a lot of hoops you got to jump through. And this is just on the corporate side, mind you. I know we've talked previously about the pass-through component, which is a whole separate animal. But on the corporate side, I think that's the kind of the methodology you want to be thinking about it. Is it in the base? If it is, how much is in the base? Do we get a subtraction, whether it's a DRD or a specific exclusion from the base? And then what are you doing from an apportionment perspective for the sales factor?
Rattling through this here, right? Another area, 163J, the changes they made to the business interest expense limitation, maybe how that's kind of working at the state level as well.
Yeah, and I think, and this applies to GILTI as well, but 163J I think is tough, especially in the separate company filing states. And so, as most people know, I mean, there's different filings you can have for corporate state income tax. I mean, you could have a unitary group or combined group, which kind of mimics your federal consolidated return. You could have a nexus combined return, which, of your, say, 10 entities in your group, only 4 of them have nexus in the state. So that, that those 4 entities file together. Or you could have your separate company reporting states, which is basically a pro forma for each entity that has nexus in the state. And so, as you've talked about, there's still moving pieces as far as how you calculate the limitation at the federal level. The best of my knowledge, you treat all of the entities together as a single entity, but I think a lot of that is done through the 1502 regulations, right? And so there's definitely more than a handful of states that don't adopt the 1502 federal regulations because they don't have to, right? Say like a Tennessee or a Missouri or other states that are separate company reporting, 1502 really doesn't need to come into play. But as a result, then how do you calculate the limitation for 163J, right? I mean, do you look at the entity as a true separate company and calculate it at that level, or do you still kind of conform to the federal limitation, right? And this, of course, is after the whether or not the state conforms to 163J at all, right? I mean, if it just conforms, or you've got nonconformity, I mean, that's step one. But then, if you do have a reason that you need to calculate the limitation at the separate entity level, I mean, I think it's a tricky proposition that not many states have really put out any guidance on. So it's really kind of something that just needs to continue to be monitored and thought about as you're filing returns where you might have that impact. One other thing about 163J is this whole idea, it's been around for a number of years now, but states didn't like all the planning with regards to related party debt, and intercompany interest expense being paid from, say, subsidiary that had nexus in state A and to the parent who had nexus in no states, right? So you're getting a deduction without that interest income being paid tax on in the same state, right? And so from a federal perspective, it doesn't matter, right? I mean, the intercompany, it's all eliminated and, it all flushes out. But from a state perspective, I mean, this is relevant, right? So any client, company, or taxpayer where you have intercompany interest expense, I mean, how do you layer that into the analysis, right? And if you have a limitation, like, what do you look at first, right? Do you look at your third party interest? Do you look at your intercompany? Like, how do you do that? And I just haven't seen much guidance on that at this point either.
That's a challenge. And maybe it's a good time to ask, or can I get your thoughts on this, of approaching the fact that, one of the struggles we've had on the federal side, but in particularly on the state side, right? As you mentioned, that in a lot of cases, we don't have any guidance, or there isn't, the shoe hasn't dropped yet on the state level. Any thoughts on I guess how to approach that?
Well, I'd revert back to the kind of the same comment. Well, one would be to be consistent from year to year and across all the states, because, well, for one, I mean, this is specific to non-business income, but I mean, you will see questions on the state returns, on corporate returns, like basically, are you treating this, item of income consistently among every state. And so you want to be able to answer that yes, because that's red flag number one. But two, I think you want to find any guidance that you can, and in the absence of guidance, take a practical approach that you think is fair to both the taxpayer and the state. Say like, if we have a 50-50 split between, say, third-party interest and intercompany interest, if there is a limitation, we're going to apply it 50% on each component. So, I think something practical where, upon audit, the state can't just say like, oh, hey, wait a second. Why are you applying the limitation only to the intercompany component, when it's clearly in the taxpayer's favor? Granted, there's no clear guidance, and depending on if you want to be aggressive or not, I mean, that plays into it too, because obviously some taxpayers are much more apt to be aggressive in the absence of guidance, but just know that there could be some risk there.
I know there's been some conversation. We talk about GILTI 162J, some of the issues there, but specifically on GILTI, there's been some conversations about constitutionality and states where it's taxable. I don't know, any thoughts or observations around that?
Well, yeah, it's going to be interesting because it's really the Constitution, the U.S. Constitution, that kind of guides the principles for the state's ability to tax. And so the Commerce Clause or the Foreign Commerce Clause, basically, there has to be equal treatment for domestic income and foreign income for states that are taxing it. And so it reverts back to the Kraft case in 1992. Basically, Iowa, just to put it simply, was giving companies a DRD for dividends for domestic subs, but not foreign subs. And so this violated the Foreign Commerce Clause. It went all the way up to the U.S. Supreme Court. And so it struck down the Iowa business tax statute, finding that, yes, this was discriminating against foreign commerce, right? And so, I think about, the separate company states that are taxing some portion of GILTI and maybe giving a full DRD to domestic dividends because it's not under the parameters of GILTI. I think there's a constitutional issue there. And so, wait, say 4 years down the road, you've got a taxpayer that's got a big tax number, tax liability in state, state X or Y. It's going to be interesting to see if there's a challenge that goes up the chain. And I think taxpayer will have a real good likelihood of success to win on that if they kind of follow the past precedents on that issue.
Again, it just kind of adds the complexity, adds to the challenge, right? Of not only are we kind of digesting what it means at the federal and then in the state level, but even just these larger issues to deal with it as well. So how have those conversations maybe been around some of these provisions, like GILTI and the constitutionality issue, when you're talking to taxpayers and those that you're working with?
Well, yeah, it's hard because, you've got all these different provisions and guidance that's not consistent among the states, and you get into the issues of combined states versus separate company states, and how do you get the relief from GILTI like you get on the federal level? The 250 section 250 deduction, which reported on line 29B. As you know, most states are line 28 for starting points, so that's kind of out the window.
Can anyone tell me which federal tax form Mr. Pierzchalski is referring to? Anyone? 2018 Form 1120, the U.S. Corporation Income Tax Return. Back to you, Pierzchalski.
I think it's going to be a tricky issue, but I will say that I think the sample size for where this comes into play, it's not going to be a ton of states because you're looking mostly at, separate company reporting states, and you're going to have a taxpayer with specific facts say like, okay, one, we're not getting full deduction or exclusion in the state, and two, like we're based out of, say, Tennessee, and our apportionment factor is like 75% or, something large, right? So that it becomes a pretty material number. to make it worth the taxpayers, effort to say, hey, we want to, protest this, and we're willing to litigate it, right? Because that's always the interplay between, I feel like, states and taxpayers is like, yeah, we don't agree with this issue, but we don't want to get litigation or lawyers involved because it's by the time we maybe settle this out or we win, we've exhausted so many fees. Maybe we got to balance that out as far as how hard we really want to push this.
It's a strange concept in a way to think about it. Actually, I was talking in the previous episodes of the podcast about the concept of we're dealing with laws, maybe akin to a speed limit and speeding down the highway. And, technically, if you're speeding, you're breaking a law. But then you have to decide, well, how many miles per hour am I going over? And what's the risk in that? And I mean, it's kind of almost a parallel here, even though, again, maybe it seems strange to think about a tax law in that context. But I don't know, would you kind of agree with that notion and maybe that metaphor?
Yeah, no, I absolutely agree with that. Always consider, what's your risk profile, right? Do you just want to take the position and document it and roll with it and understand that the state's going to challenge it and, be ready for that challenge? Or two, do you want to take it to the highest level if it's a big number? It's definitely a balancing act.
For sure. Yeah. So I guess keeping with some of these international provisions and kind of the state level considerations. I know there's obviously a few other areas that we had some significant changes on. So what are some of those and what are you seeing and hearing?
Yeah, I think that the big one, that we haven't touched upon much yet, just because it was, a bigger issue last year, was the 965. So the repatriation transition tax, right? There was a lot of work done last year, kind of going through the analysis, how do states conform? If they do conform, do you have base impact? Is that impact at gross or is it at net? Basically allowing the 965C deduction. And then what's your sales factor component? Because again, states will challenge and just say, like, as far as what goes in the sales factor, is this a true receipt, right? Or is it just, maybe phantom income's not the right term, but it's, income you're being taxed on, but you're not truly bringing that cash back. So is there a receipt of this cash, right? And then two, for the non-conforming states like California and others that you didn't have any impact last year, I think it's going to be a compliance nightmare going forward. So say in 2023, you actually do repatriate some of this cash that for federal purposes, it's a non-event because you've already paid tax on it, right? But in California, you haven't. So you're trying to separately track E&P, and do you have a way to back that out of the base, say 3 years down the road in California and other states? And so I kind of equated it to bonus depreciation, which I think is just also a compliance nightmare from a state tax perspective, because countless states just were having different ways that they were adding it back and then allowing a subtraction over time. And so I feel like taxpayers are having to track that in so many different ways from a state tax perspective, just to keep it all straight. I kind of worry that there's some element of 965 that's going to be the same way going forward, absent any kind of legislative change in some of these non-conforming states.
Obviously, all of these things that we kind of been talking through is just some of the challenges and maybe the differences between, that pass-through entities are facing versus corporate entities and C corps and the taxation, how that works. What are some of the considerations there that we haven't mentioned? Those that are specific, I guess, to pass-through businesses.
Yeah, pass-throughs, it's tough because anyone that's done state partnership returns or LLC returns that are true flow through entities, I mean, that the guidance is not very good as far as the really detailed, like, okay, what's in source income and what do we get subtractions for? And so it's really the same way as GILTI as an example, that so much of the guidance is at the corporate level, that what do you do at a pass-through, knowing that you can't rely on a DRD or any way to back that out. And so as far as compliance, like, okay, we probably need to have a separate note or footnote on our K1, right? It says, okay, this component of of income is related to GILTI, and you need to consider this for, your state income tax impact at the individual level, or if the case where you have a corporate partner. I mean, you roll back into the separate set of rules that at least there is guidance, but corporate partners need to take that into account when they're filing their separate corporate returns. And so I think it's tough from a pass-through entity compliance perspective, just because there's just not great guidance from a state perspective. And anybody who's used software, tax compliance software for state partnerships returns, I think would agree that compliance software, it's great. C Corps, it's great. On a whole state C Corp returns, it's great. But state pass-through entities, it's like, okay, well, what's being bundled into source income? Like, why is this the case? There's nothing in the instructions. There's nothing in the actual regulations as far as like what we include and exclude. So I just think it's going to be difficult to manage all that here in the years to come.
And maybe that's a kind of tease up something you mentioned in the beginning, right? A lot of your experience with doing some of the due diligence. Obviously, there's been a lot of, well, maybe it's not obvious to some, but I think for you and I, right, it's been obvious that there's been a lot of M&A activity, a lot of interest in that. A lot of the closely held businesses that we work with are in a lot of cases seeing some really great multiples out there, and maybe using that as an opportunity to take some of the risk off the table, or to kind of cash in, or meet their succession and continuity needs. But when you go through some of those due diligence projects and those that you're working with, obviously these new considerations, these challenges that you're talking about come into play, I would think. So what are some things to think about, again, going forward, and what challenges are companies facing there?
Yeah, I think it's going to become way, way more prevalent in the years to come, because we go through our diligence reviews now, and there's so much focus on Wayfair and all of the updated sales tax economic nexus laws that are in place. So pretty much a standard question at this point, like, okay, have you considered Wayfair and the impact of the business that you're doing in all these states that you haven't had to worry about in years past? Have you updated processes for filing returns, or collecting exemption certificates in these states? And so I think you're going to have, or you will have, the same impact with federal tax reform. It's like, say a year down the road, we get 3 years worth of returns to look at, 17, 18, a multinational. Okay, I see you had 965, or you had GILTI on the federal income tax level. I don't see any analysis on the state level. Like, what did you do? Like, what have you documented? Because, a lot of times, unfortunately, the answer we get is like, we just didn't look at this, or we didn't really put a ton of analysis into this because, we didn't think it was material, or, we just didn't have the bandwidth to do it, and we had to get our returns done. And same with 163J. If you've got a consolidated return with separate filings, have you done any analysis? And if not, do we need to, request indemnification on all this for our buyer, help calculate potential exposures? So I think it's definitely something that's going to be more prevalent as time goes on, because as you mentioned, I really, at this point, the economy, the M&A market, I just think is really hot. And so, these issues are, they're not going to go away. And so it's something, you want to get in front of now, because I always feel like we get on these calls, or if I'm helping my clients that I know might be up for a potential transaction or up for sale, it's like, as a CFO or controller or tax director, it's not a good look, and not the type of thing you want to respond to and say, hey, I want to talk about the tax findings, the diligence. Like, why didn't we look at these like 6 things? Like, and now we've got this being excluded, or a request for indemnification on this. It's just not a good look, and it's something you can get in front of appropriately. I think that would be the best course of action.
It definitely converts the risk of something that might happen on an audit or exam down the road to actual dollars and cents at closing, right? In
Right.
form of holdbacks or whatever it may be, or reduced consideration. I mean, it definitely flips the thought process on that, I would have to say.
Oh, no, absolutely. And like I said, I think the scrutiny is only going to go up over time as there's more years of returns that have a potential GILTI impact, or 163J impact.
I guess maybe if you're someone that says, well, no, I'm not going to consider an M&A type transaction. My 20-year outlook here is to continue to grow and stay the course. And, obviously then you start to kind of analyze some of the audit risk and exposure with some of these things versus maybe converting to a due diligence challenge. Although, like you said, you never know. Sometimes a home run offer could come in tomorrow that no one was expecting. But I guess looking at some of the challenges in the future audit considerations, you sprinkled them in here, but I don't know, is there anything else that you would mention along those lines or things to be thinking about or watching for to be ready and prepared?
Yeah, I think it's going to be tough because of the time lag that is going to occur in a lot of these cases, right? So you may have turnover in your department, or even turnover if you outsource this to an accounting firm to do your compliance, because they bring the expertise, but that was 3 years ago, and the senior manager that was on the account has since left, and you've got a new team that's trying to get back into notes and figure out why we took the position that we did. Not to say that, that can get done, but it could be an additional headache or hurdle. And two, as you know, and this, no offense to the states, but, not every auditor is as experienced or as sophisticated as others. And so, at the field level, if you have issues with 1502, or you've taken positions that you think are good positions, but maybe you have one instance where, an auditor that you're working with, isn't as up to speed with the issues, and then you're trying to get in the right way to kind of work with a supervisor or protest before you get some kind of formal assessment, because as it's always ideal to work these issues out at the field versus having to go through the formal channels, just because time and potential expense that you have to go through when you've got more, like a formal protest or administrative hearing. So I think that's going to be a challenge too, as far as, who you're working with. And if you have complicated issues, like the best ability to kind of get that worked out at the field level, if you can.
Similar to the diligence thing, right? It's not things that you like to think about, but it's definitely it's an important part of everything. So maybe again, kind of keeping that future outlook, year and a half or so in with these changes, and I've had now a chance to apply them, understand them a little better. We've seen a little bit more. Are there planning things that you would say taxpayers should be thinking about right now from the state level perspective?
Obviously, keep up to date with legislation. I think that's key. Whether or not you have an internal process, or maybe like your department, there's somebody in charge of here's the latest and greatest, or you rely on your advisors to keep you up to speed on legislation, because it's constantly moving. Missouri finally passed legislation that said, okay, we conform to 163J. California just passed some legislation. It was really their first, passed legislation that touched on tax reform, federal tax reform, and it didn't touch on GILTI or any of the big topics that we brought up. And so, this is going to keep moving, over time, and it's really ironic that some states have been so slow on some of these provisions, but like the example of Wayfair and sales tax, it's like they were chomping at the bit, and there was just so much speed and efficiency to get things passed as soon as possible. And so, it's really interesting, like looking at the two diverting angles that the state took on that one. But as far as planning goes, the kind of the basic blocking and tackling, where look at from a 163J perspective, if you're subject to add back, look at if there's ways to alleviate that, whether it's maybe restructure, your organization, or maybe a way to change notes. There's things that you can do there.
We've covered a lot of ground, and honestly, we could probably keep going, right? For the better part of the day, talking about some of these finer points and some of the challenges, the complexity in applying them. But is there anything that you'd say we haven't covered that you want to maybe add in?
The only thing that I would potentially encourage taxpayers to focus on is the sales factor treatment. So if you get into the issue where a portion of the foreign income, whether it's GILTI or 965, historically, or maybe in the future is deemed to be taxable, like what are you doing from a sales factor apportionment perspective? Because I think the states would lean toward well, it's akin to a dividend, so it's out of the base, or it's out of the factor, right? And the taxpayer argument would be, well, there's this whole concept with past case law and just, this no taxation without representation, in the sales factor, right? So if you're paying tax on a portion of foreign income, should you get some kind of representation in your factor? And then you get into the challenge of like, where do you source it, right? Because in most cases, if a state would allow a dividend in the factor, I'm certain that the state's argument would be like, well, source it to your state of commercial domicile, right? I don't care if it's a foreign dividend. There's precedent that, especially from a non-business allocation perspective, that or even interest income from a sales factor, perspective, source it to your state of commercial domicile. Whereas, well, this is foreign income, right? It should be in our denominator only. It's foreign. It has nothing to do with our domestic operations. And so, I think there's the issues related to the sales factor that taxpayers need to really be looking at closely as far as how you're going to treat any income that's taxed. And then the other thing that we haven't touched upon would be issues related to basis when you have GILTI or 965, and this kind of goes into the discussion we started down as far as like, how is the state treating this for the taxable income base, right? Do you have an in and an out, right? So you have a income inclusion, but then there's some kind of separate subtraction, or you can rely on the DRD. Then you would argue like, you probably have some kind of basis increase, and you have a previously taxed income component, and then when the cash actually comes in the door, you don't have to worry about income. Versus if you have a state that specifically says, okay, GILTI is not an income, right? A specific exclusion where it's not even showing up on the return, then you have to look at the opposite. Like, okay, well, probably don't have any basis, increase, no PTI. And then you got the opposite answer when the cash is actually, distributed back as far as, being in the tax base.
Find all that just particularly both fascinating and almost overwhelming, again, because like I said, I'm clearly not the state and local guy here, right?
Right.
Just hearing you talk, and it's almost like looking into a mirror, where there's a mirror behind you, just kind of keeps reflecting back and forth. It's like you can kind of boggles the mind almost of how complex some of this is when you start to funnel it down to the state and local level and things that you just don't think about, I guess.
Yeah, no, I totally agree. It's like you think it's as simple as, okay, well, we have 163J at the federal level, and then we'll have it at the state level too. But then you don't get into you start with the conformity issues, but then you get into the layers of complexity. It's like, okay, how do you calculate the limitation? Do we have an apportionment play? You bring in intercompany expense, interest expense if you have that. So I feel like there's these hidden is probably not the right word, but these layers of complexity that on the face of it you wouldn't necessarily think are at play if you don't work in the state tax world for a living. You think it should be simple, but as nothing's simple when it comes to tax, both federal, state, or international, right?
Well put. Any advice for maybe a tax practitioner or a tax an internal tax team member in a tax office that's coming up here on what's going to be a very busy time with the deadlines approaching?
I would say, again, try as best as you can, figure out some kind of process to stay on top of legislation, whether it's be through, subscribing. I know BKD, we do articles with ThoughtWorm, and other firms do it too. There's a lot of good content out there that, the key is making the time to really go through it. Cause I know that's hard for even me. It's like, you've got so many deadlines and different things going on that it's hard to take an hour a week to just say, I'm just going to read legislation, right? But ultimately, I mean, it needs to be done by somebody just to make sure you're not missing out on, updates or, even opportunities. Maybe you've applied something, some kind of limitation, or you'd applied something on a return in past years, but now the state finally has guidance as far as maybe, positive guidance that, okay, hey, maybe we've got a refund opportunity here. We didn't need to do it this way, right? And so I think that's key. Just get as much knowledge as you can. And two, like I said a couple times, just document, just so that a couple years down the road, you're not trying to reinvent the wheel, remembering why you did what you did, or, what you relied upon, because this is not going to go away anytime soon.
class is over for today, but join us next time as our Back to Tax Reform series continues with a discussion on applying the TCJA provisions for construction and real estate. Before you go, I'd really appreciate it if you leave us a rating and review out on Apple Podcasts. They go a long way in helping others ace the Simply Tax School by finding the podcast. Show notes to today's episode, which include more about our guest today, are available at bkd.com/simplytax. You can find me out on Twitter at Damien Martin CPA, on Instagram at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and on LinkedIn. I'm Professor Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.